Hi guys and fellow investors. Welcome to the Savvy Investing series. Finding good stocks for long-term investing is a tough task. Nowadays, when stock market is filled with thousands of companies, with YouTube, OTT, and IPL boosting their advertisements and sponsorships, often good companies get overlooked. As Peter Lynch once said, dull mundane companies that are almost invisible from our life are the companies that make the best profits. Today I am going to show you how to identify if a company is good and also to find leads for good companies. Let's start. I am going to use Screener website in this video to find and analyze companies. So go ahead and search it on Google. The top response with the bars is the one. Once you log on into the website with your Google or email, you will prompt into this dashboard. This is the feed section. This includes news about companies you will get updates from once you start following. Upcoming quarterly and annual results section are on the left. We are interested in the screens section. Go ahead and click on. This section basically used to query companies based on sectors, popular themes, popular formulas, or you can make one yourself. We are also going to make one ourselves. So go ahead and click on create new screen. Creating a screen is quite easy. We just put in a bunch of parameters that we want our stocks to fulfill and click go. So I have typed in some parameters like market cap greater than 250, which is obviously in crores, year on year quarterly sales growth greater than 10%, price to earning ratio less than 85, and return on capital employed greater than 15%. We'll run this query. Here are our query results. You can export this data to an Excel spreadsheet by clicking export if you want. You can also sort the data depending on any parameter by clicking on it. Let's sort it on the price and earning ratio in ascending order. Now you can pick any company. I'm going to pick Prakash Pipes. This is the first section you will bump into when you click on Prakash Pipes. It contains basic details about the stock, its current price on stock exchange, its website, code on BSE and NSE. Market cap that is 1008 crores, so it's a low medium range company. Price to equity ratio is 10.3, which is low. That's a good sign. Return on capital employed is 32.7%, which is also good. Current price is 2 to 3 times the book value, which is not that bad. And for a growing company, return on equity is 27%, is also good. Dividends are okay, and a face value of 10, which is also okay. The About section gives details about the business of our company. Prakash Pipes is engaged in the manufacturing of PVC pipes and fittings and packaging products. It was incorporated in June 2017, created out of a demerger from Prakash Industries Limited. Remember, a thorough research is quite necessary not only to find good companies but also to fall from making bad investments. Now we click on Read More and we see this information. The read more section gives a basic outlook about the business segments of the company. There are two segments. First is the PVC pipes and fittings, which is about 61% as seen on financial year 2025 quarter one, while the second segment is flexible packaging, which is about 39%. Now the company has seen growth in the second segment, while the first segment has remained flat. There are also information about the geographical operations of the company and also the expansion and investment plans. The company is trying to expand its packaging capacity, and in the investment section, it has made investment worth of rupees 42 crore in equity instruments and mutual funds. The focus of the company is to introduce a new product line for HDPE drums, which is crucial for pharmaceutical, chemical, and food processing units. This is some info we got about the company, but still we should go through past annual reports, market outlook for the company's niche, and other financials that we will look further for making better decisions. Next section is the charts. Charts gives us a rough sketch into the company's past, how it has performed over the years. Click for 1 year or 5 year max to see. We can see that company has grown in the past few years. Now go ahead and click on the PE ratio on the left to get an understanding of the PE in past years. The dotted line is the moving average, and it's always good to buy when the PE is below its moving average, i.e. the dotted line. In last 1 year, it's been below the dotted line, which shows that it might be a good time to buy. But we have to analyze other things first. There are other sections for charts as well that you can take a deep dive onto. This site also shows some pros and cons about the stock that you can see, but they are not that up to the mark. Next are the peers. This shows us how other companies are doing within the same niche, like Supreme, Astral, Phenolics. You can compare the PE of the chosen one with the other companies. This also gives you a shot to look at other companies which might be better performing. The median PE is 25 and Prakash Pipes has a PE of 10, which is quite good. Similarly, the return on capital employed is also way higher than the median. That shows it's performing better from its peers. This section shows us the quarterly results. Companies follow a financial year from April to March. You can see how the company is performing quarter on quarter. Sales are almost on the rise with some down quarters. So is the operating profit. It's good to look on both as sometimes sales may increase but expenditure increases more, which cuts profit. We should keep an eye on both. Yearly results are released at the end of every financial year. As you can see, there is a linear growth. Operating profits are also on the rise. Financial are another very important section for a company. Sound financials are the backbone of a company in case of a downtime. Long-term borrowing should be less as they put pressure in case of a market collapse. Our company has low long-term borrowings as compared to fixed assets. This is a sign of a sound financial. Next, we have is the cash flows. These are the most neglected by an India beginner investors. First, let us understand the three types of cash flows a company operates within. Cash from operating activity. This refers to the net cash flow the company yields from selling of its products and services. This involves buying raw material, procurement, transportation, marketing, and the profits. Cash from investing activity. This refers to the net cash flow the company yields from investing in the company. This includes things like buying new machinery, equipment, land and buildings, factory, plants, etc. Third one is the cash from financial activity. This refers to the net cash flow the company yields from financing activities like loans and borrowing, share buyback, lending, etc. We look cash flow of at least 3 past years. A positive cash flow on operating side is preferred. This shows we are selling products and able to receive money for that. Startups usually don't have positive cash from operating activity as they don't make profits in the initial years. Cash flow from investing activity shows expenditure on growth, R&D, and development, while financing cash flows are negative when you borrow and positive when you lend or buy back shares. A positive cash flow is always preferred, but even if it's negative, it should be justifiable. Annual reports are a good source to understand company's financial and where the money is being spent and how much is made. The ratio and the cycles. They give you an idea about the life cycles of a product. It's journey from your manufacturing plant to the customer and the money from customer's pocket to your hand. Not yours, it's actually the company's hand. First, we should understand the terms. Debtor days, also known as days sales outstanding, is a financial metric that measures the average time it takes a business to collect payments from its customers after making a sale on credit. Inventory days, also known as days sales of inventory or days in inventory or days inventory outstanding, is a measure of how long on average a company holds its inventory before selling it. Days payable outstanding is a financial ratio that measures the average time it takes a company to pay its suppliers and vendors. The cash conversion cycle, also known as cash cycle, measures the time company it takes to convert its investments in inventory and accounts receivable into cash. Working capital days, also known as days working capital or the working capital cycle, measures how long it takes a company to convert its investment in day-to-day operations like inventory and account receivable into revenue. We want these cycles to be as short as possible so we can make money as fast as possible. You wouldn't want to give the product today and receive the money a year later. Now we come on to the shareholding pattern. This tells us about who owns how much. The promoter are the company officials, owners, and people who had put a stake in the company from its founding days. A fair share of company is owned by them, and it is expected. A rise in promoter share is preferred as it shows confidence that they think the company will grow. FII and DII are the institutional investors. As an individual investor, we don't want to have a large share of the company owned by them, since they could then put in and out their money anytime, and this will make our share too volatile to place in long-term bets. Finally, we are at the extras, which are also very crucial. Don't dare to ignore them. Announcement includes dialogues from RBI or SEBI from a compliance perspective. You should keep an eye on them as SEBI and RBI introspects if there is some inner gamble or scam to fraud individual investors. Annual reports, as I've said, are a must read. Conference calls, often ignored, are very, very important. Investors and company officials and executives have dialogues from time to time about the company's growth, future plans, big changes, merger, and acquisition. They play a crucial role in our investment also. To hold, buy more, or sell out if you don't think the outlay is good enough. Usually, they provide a transcript which you can read entirely, but we are AI connoisseurs, aren't we? We can get ChatGPT to summarize it for us. Thank you. Hope you liked my video. I tried my best to give some basic insights. Keep learning, keep hustling, and do share good companies if you come across.